Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. Now, if you're out there and you can hear me, please type that you can hear me in the comment section because the last couple of days I've had a couple of difficulties with the mic, so I just want to make sure everybody can hear me. It looks like it's always okay on my end, but on your end, it might not be coming through. So please let me know if you can't hear me over on the side because we are starting. And if you can hear me, just give me a heads up because that'll help me out here as we're going along. All right, so usually I'll start out with the economic data, see how that's impacting the markets, and then we'll talk about some opportunities I can find in the markets, and I'll share them with you. All right, so without further ado, across the pond, not really a whole lot going on there, but a couple of things that we've been talking about recently. Yesterday, I tried to talk about this without a mic, but today we will. Consumer price index. Remember, we're talking about inflationary gauges here, and consumer price index is whether or not the wholesaler is passing on higher prices to the consumer. Now, this is important because we've been hearing inflationary things from the FOMC, whether they're going to be transitory or whether or not they are going to be here to stay. Well, these are the numbers that we're going to be able to tell whether or not they are transitory or not, because we can strip out some of the more volatile transitory inflationary aspects of these economic data points and determine whether or not we really believe these are going to be transitory. For instance, yesterday we got the consumer price index. That's the broader consumer that's consuming goods. And it could be a manufacturer or a service provider. So those products are still considered consumer. In that, we have the consumer price index coming in at a little hotter than expected at 0.4%, so 0.1% higher than what was expected. But when you strip out food and energy, those are some of those transitory things that we were talking about with the Fed. That came in at 0.2%. So when you strip out the more volatile aspects of that economic data point, it actually looks pretty in line with the thesis that this could be transitory. As a matter of fact, we're already starting to see shipping prices from China coming down. It used to be around back in the day, it was around $3,000 to $5,000 to ship a container or a container from China to the United States. Now it jacked up to around $20,000. Now we're seeing about a 20% reduction from that number. So around 16,000. So nice to see that these are transitory. It's not going to stay elevated that long. And we're actually seeing these prices come down on shipping much quicker than before. Now, when we strip out and we get the producer price index, that is what we are going to start looking for to pass on to the consumer. Now, those numbers are starting to come off. Producer price index 0.5%, expected to be 0.6%, starting to get us to believe that some of these data points are not as solid as what we were thinking, meaning that they are in fact transitory. And when we strip out the food and energy from the PPI, those volatile aspects of that data point coming in much lower than expected at 0.2%, expected to be 0.5%. Finally, rounding it off with unemployment claims, those are lower than what we were expecting, coming in at 293,000, expected to be 315,000. Now, something to note with this number is I did hear some data points earlier on this week where we were hearing that more people are actually quitting their job than actually getting fired. So that's probably not going to show up in unemployment claims. Why? Because when you quit, you don't get unemployment. So that number could start to look a little skewed here going forward. Now, natural gas storage is coming in a little bit lower than expected at 81 billion cubic feet, expected to be 97 billion cubic feet. Mountains are already starting to get snow. That is going to start driving demand for the natural gas there. All right, so let's get on with the overall markets and see how they're reacting. We had gold futures making a move here higher into the 1800s handle, just above that 50-day simple moving average. Keep in mind, though, folks, it is right there at the point of control. We could see this slightly move up into the 1800 handle, but again, this was on the thesis when I was talking about moving up to 1819 was that the inflationary numbers were not going to be as transitory as what we were originally thinking. Now, are we talking about transitory inflation here with crude oil? Crude oil is going to start having a similar reaction to the overall markets. And we can see here crude oil making a nice move to the upside. breaking up into the 80 handle, I don't think this is sustainable, folks. I think that we're going to see some weakness in demand for it and start rolling over just a little bit here going forward. I just don't think it's sustainable necessarily. And to be quite honest, these kind of numbers in an economy that we have going on right now could be detrimental for sure. And then we can go over and look at the Nasdaq. Something to note here is it has broken back above the neckline that we've been talking so much about. So that whole measured move to the downside where we take the top to this neckline and make that a measured move, which really put us down here to about the 123 Fibonacci extension. That lines up quite nicely with the 13,000, let's call it 13,900-ish area. I don't know if it'll actually tap that because we have a lot of support levels. I was expecting us to come down and test that 200-day simple moving average, which is looking like it is out the window at this point. We are not going to get a follow through on this head and shoulders on any of these markets. Something to note, I might actually do something like extend this to the downside because I think that that could definitely start acting as a support level on that trend line because it has several times before. It should act like that again. Again, though, starting to see some of these points of control to move a little bit higher. That's acceptance of value at higher levels, folks. That means that we are looking at risk to the upside in equities for the I would say at least the remainder of this week, and for sure probably going into next week, we are going to see some bullish sentiment here. As long as we can continue to see some good economic data, I think that we are going to see that start to happen. I want to talk about a couple of trades that I was trying to talk about over the weekend is some of the, or over the last couple of days, because some of these trades I took off and was trying to talk about them in these spotting the trade videos. So I just want to make sure everybody's clear that I have taken off this straddle. Now what we did is we went in the October, sold the 55 straddle when we had some high implied volatility. Now notice I was expecting the volatility to come out, although it went against me because we don't want to see volatility expand when we're selling option strategies, right? We want to see these decay. Now I did over this time. It didn't move anywhere, so I got a lot of good theta decay happening out of this trade and started to make the move to the downside past couple of days. But keep in mind, I did cover this on the 11th, so I did get out of this right before we got this drop. I tried to talk to you guys about this in this market commentary, but or in the spotting the trade that I covered this trade. Sorry I wasn't able to get in there, but anyway, I had on the October 55 straddle. Remember, that's selling the 55 calls and the 55 puts. I originally sold this for right around $3.25. Got that collection credit. I'm usually looking at getting out at around 50% of max profit on a straddle because it's right there at the money. Those are going to take a lot longer to decay, and when volatility starts expanding, folks, at the monies are going to be the ones that see that volatility into those premiums. So although I did get the time decay, nailed it right there at the point of control, one of the problems with this trade was that the volatility expanded, so that kind of offset some of my gains throughout this time. So it took a little bit longer to get out of it. In that, I ended up covering it for right around $1.50, so just slightly in line with my my rules for getting out of 50% of max profit. It was able to squeeze out just a little bit more on that trade there. And then Las Vegas Sands, I was trying to talk to you folks about this yesterday, about covering this trade, and I had shorted the October 34 puts in here, and right around this day selling puts because the premiums are high. We know the premiums are high. Why? Because that volatility is at elevated levels that we haven't seen for this underlying. That means I can take advantage of really rich premiums. With that said, then I decided to, if the market continued to sell off down here to this 34 level, I'd be more than happy to get out of get long Las Vegas Sands because I'm selling puts. That means cash secured puts in a sense. If it goes below that level, that's where I'm willing to buy it. I'd be more than happy to buy Las Vegas Sands for all the reasons that I've talked about with these casinos having higher profits, the highest profits they've seen ever. In that, selling the 34 puts, collecting around 95 cents lowers that break even to right around 33. So even further away from where that underlying was trading. got the theta decay. You can see the volatility did come out. Theta decay is when it just happened as every day goes by, that thief in the night theta comes and picks your pocket. That theta was really what was allowing me to get out of this trade on this particular instance. And I had sold the October, like I said, 34 puts for right around 95 cents. I bought those back yesterday for around 2 cents. And then finally, I wanted to talk about GDXJ because I did cover that earlier this week, and I'm actually looking at another opportunity for a butterfly for this trade, and we are doing the short put butterfly webinar today, so please check that out. I'm going to talk about how we can take advantage of this underlying for the short put butterfly. You can see volatility has come out of this. We're at relatively low levels. That leads us to believe we need to be doing a strategy around expansion of volatility. I'll show you how to set that up today. But with this trade, I took advantage of the high volatility in this underlying and was able to do, again, we're looking at like cash secured puts, selling cash secured puts if you're in an IRA, or with me, I'm looking at it as a trade, but I had sold 2 separate times on the 21st when we had volatility spike here, right here on the 21st. I sold some, and then we got another little spike in volatility right around the 28th here, and I added to that trade because I was expecting to see inflation start to show up here, and that would be an inflationary gauge. People would be going to buy this. So with that said, I had sold the September 21st, I sold the October 38 puts for about 79 cents. Volatility did start to spike here again. I added to that trade when we got down to this low level here. I was like, this is getting a little crazy. It's an opportunity to add some more in this. So on the 27th, I was adding to this trade, sold the October 38 puts again, but only for 59 cents this time around. So right around 69 cents is my break even on this trade. Now you can see the market started rallying. I sold puts. That means a bullish move. It helps me with this position. Volatility coming out. We know that when volatility comes out, those premiums start going downward, right? As volatility comes out, prices become cheaper. That's good when we've sold originally. Sell high, buy low. Was able to cover this trade on the 11th for 6 cents. So out of this, despite the fact that the market kept moving higher, I probably could have saved a couple of pennies and banked that. Maybe I left a couple of pennies on the table, but at the end of the day, for 2 or 3 pennies, it is not worth the risk for something happening and dropping down there. Take your money and run is the way I like to look at it. All right, so folks, if you've had anything to take away from this, I do appreciate you guys throwing a like button up there. It feeds the bots that runs out there and finds somebody that looks just like you. And make sure you guys are commenting. I'll circle back around and make sure that I'm making sure everybody is clear of concept. Thank you, John, who we can finally hear today. and comment, like I said, so I'll circle back around and make sure you guys are clear of concept. And finally, make sure you guys are subscribing and hitting the bell right next to there, because the bell is actually what will give you a notification if I come on unannounced. So please make sure you're taking advantage of that as well. That's all I got for you guys. Have a great day. See you this afternoon. And if you can't take that, take it easy.